Okay, I'd like to call this meeting to order at 4:11. And can we have a roll call, please?
Chair Carol Kendrick,
Here.
Vice Chair Jackie Peterson.
Here.
City Treasurer Dale Dealman.
Present.
City Manager Mark Bristwick.
Present.
Acting Administrative Services Director Tiffany Burnett.
Present.
Okay. And now let's do the Pledge of Allegiance.
It says from the last minutes we directed towards the mayor's office.
Oh, yeah.
Okay.
That's fine.
Ready, begin. I
pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Item 4 is communications from the public. Anyone who wishes to address the Board of Trustees regarding items listed on the agenda and not on the agenda may do so at this time. Public comments are temporarily limited to 2 minutes. Please state your name when the chairperson calls for your public comment. When you are recognized, you may proceed with your comments. The Board of Trustees is prohibited from taking action or discussing any item not occurring on the agenda. The Board of Trustees may take action to direct staff to place a matter of business on a future agenda. Do we have any communications from the public? Nope. Okay. Moving on to presentations. So 5A is a receive update on local government and investment pools and money market account. Can we get a staff report, please?
I don't really have like a formal presentation. It's just to go over what we have done since we've last met. We have opened up the 2 new accounts, the LGIP accounts with California Class and then Cal Trust. We did reach out to Camp, which was the 3rd LGIPs, and they were non-responsive and we were unable to get in touch with him to create accounts. So we've only done the 2 accounts thus far. So, and we have transferred over 15 million to both Cal Trust and to California Class. So they both have 15 million sitting in there right now. I have on the staff report itself listed out the balance in each of those accounts as of July 30th first, along with their average yield, that not the average yield, but the yield as of July 31st, 24. So you can see what they all are making right now. And then we do have our investment that's sitting with Leif. It's at 53.5 million. And that one is receiving a lower interest of 4.59. And then our money market account is the account that we use for our operational purposes, has 17.5 million in there. So right now we do have a lot of liquid funds that we could reallocate in a different manner if you would like to, if you wanted to move it more into Cal Trust or into Cal Class. Cal Class is doing pretty good. Or we can always send more money over to Bank of New York for investments with PTA. So there's a few options up to your recommendation of what you would like us to do with that. So that's pretty much for the presentation, to let you know where our liquidity lies and any kind of recommendations for investments or reallocations of the funds.
Okay.
And then it may help too, after the presentation that Public Trust Advisors provides, to see if we wanted to channel more funds over to Bank of New York for their investment strategies. So. Do you have any initial thoughts of what you're thinking?
Well, I would say if we can get a higher interest rate somewhere else, and if it's been stable, why not move it?
Because I know Leif is lower. It is lower at this point, and we have 53.5 million there. I would say move out. Shoot. We could probably easily move out 30 million. And either send half of that over to PTA or put it into Cal class right now.
And what are the interest rates on class and trust?
For Cal Trust, they actually have three types of funds that we have the money invested in. It's a liquid fund, a short-term fund, and a medium-term fund. And it's 5.34 at the
Oh, is it
end
right
of
there?
July,
Okay.
4.87 and 4.26.
Okay.
So on that itself, we are recommending to move out everything out of the short term and the medium term and just put it into the liquidity fund because it is receiving a higher yield. So, Glenda, did you want to add anything on to the California Cal Trust?
Well, just that also the other two funds that we have for LGIPs of LAIF and the class, those are both liquidity funds as well, and so I know we just want consistency to have all the money in just the liquidity funds across all three of the LGIPs.
Mhm.
So liquidity, we can liquidate at any time, and then the short and medium, those, we have time limits up before we can liquidate them.
Yeah.
Okay.
They're not long,
Not long.
yeah, it's like a day or two.
Yeah,
Oh,
Yeah, it's not,
it's not long.
yeah. So, but they are not receiving as much as the liquidity fund is. So my recommendation would be to move in that, what is it? The 14 million into just having the one liquidity fund and not worry about the short term or the medium term.
And I'm
That sounds good to me.
yeah,
It's like about a 0.5% more than the short term and then even more than the medium.
And then California class is, as of July 31st, is performing better than Cal Trust, but I mean, that they're very neck and neck. And then with Life's balance at 53 million. And I mean, our Wells Fargo money market itself is at 17 million. We could move out funding out of that and put some in California class. Or see the recommendations that we get from public trust advisors as well.
For context, the really great news is we have a lot of cash that's being invested right now. And in recent years, we haven't seen these types of returns for a long time, so we're in a remarkably good position and benefiting from some of these interest rate returns. And I didn't ask you before the meeting, but I know we budgeted a little bit more for interest income, but did we underestimate based on the actual performance so far? Are we expecting to drive a bit more revenue this year? It's too early to forecast it, but we're trending above, right, the budget estimates.
Yeah.
Well, if I could jump in there,
Okay.
even though the LAIF is a lot better than it used to be. And it's not a bad rate at all, actually, but
No.
if you can move 30, you're saying did I understand the rate, you could easily move 30 million out of that?
Yeah.
Without being a problem.
Yeah, there's no problem too if we brought it down lower than that, but it
Then-
still kind of keeps it diversified.
Of course, from what you've shown us here, Wells Fargo is pretty much in line with California class. There is a slight difference, but it's not a major one. But yeah, that was possible to take that out of. I've always been suspicious of life because it's been such a poor performer in the past. But Yeah, I'd like to see us do that. We can't do it in some pays there.
Now, is 30 million, do you think is that reasonable, or would you like to see more of that funneled over somewhere else out of Leaf?
Well, if you're asking me, I'm not sure how much you can spare.
Oh, okay,
And like you said, it's always good to diversify.
Yeah.
You know,
Yeah,
what we use for daily operations,
Yeah.
just to give you more context, is that we do have a target of 8 million that's in our general checking account. This money market account is what we pull from if and when we need to
Okay.
fund payroll or
Right.
or AP check
Mhm.
runs. So this gives us plenty of money to use for the, I mean, short term, even I would say probably the next 6 to 9 months.
Yeah.
We're fine. And as our property taxes come in, sales taxes, they go into that money market as well. So it continues to build even as time progresses, so.
yeah. I'd be agreeable to move 30 million, I think. So, I think.
Okay. And then we can decide if it's gonna be to one of the other LGIPs or to Bank of New York. There any other questions?
Not for me.
nice rates. Probably a year ago.
I guess they are.
The April and May treasurer's reports will be on the September 24th agenda. And we are almost at $5 million in interest for the year. We will have some year-end entries that will adjust that a bit. But it's very good compared to prior years.
Good.
So that's just receive the update. So moving on to item 5B, which is receive an update from public trust advisors on the city of Hemet's investment portfolio.
Okay, Mark, we're ready for you.
All right, thank you all very much. And before I jump into our materials, I think I'll just offer a couple of perspectives on the discussion that I just heard regarding the potential transfer of money, just to share some observations and some thoughts. And I would just also note that it says I'm unable to share my video because the host has stopped it. So I'm unable to share video, and I'm unable to share my screen at this point. So I'm not sure if there's additional permissioning that I may need. But I can see you all, but I'm not able to share my video because it says the host has stopped it and I can't share my screen because the
Make him a co-host,
has disabled.
then you.
Okay, how about now, Mark?
Okay, I'm seeing a couple of flickering flashes on the screen here. So let's start with the video. Okay, I see my camera turned blue. That tells me it's on. Okay, there we go. Hey, good afternoon, everybody. It's very nice to see you all, and thank you for the time this afternoon. Let me adjust this down a little bit.
He's reaching out to us.
Yeah. I'm just going to go ahead and share my screen here real quick as I begin my remarks. But yeah, I think just some of the dialogue that I had heard regarding some of your liquidity positions. And are you able to see my screen? I just want to confirm.
Not yet. No.
Okay, there we go. You should be able to see that now.
Yes.
Okay, very good. Yeah, so just based upon the preliminary dialogue, as you're considering any amounts of money to move out of LAIF potentially into either one of the other local government investment pool alternatives, California Class or CalTrust, or potentially sending money for PTA to manage in either one of the 1 to 3 or 1 to 5 strategies, the biggest consideration I would say is really, the LGIPs are very liquid products. They're dollar in, dollar out daily liquidity. If you're going to give us money into the 1 to 3 or 1 to 5, that should really be money that you have no reasonable expectation of having to spend over the next 2, 3, 4 years. And so, as long as you have enough confidence that that is money that you're not need to going to draw down, you could consider parking it in one of the longer term strategies, the 1 to 3 or the 1 to 5. The difference, as you all observed, and as we've talked about on past calls right now, is we are in a very unique period of time in the market right now, and things are changing. We're going to talk a lot about that in my remarks today. But right now, the yield curve is inverted, meaning that short-term investments like your LGIPs are going to be the highest yielding things that are available to you because short-term interest rates are higher than longer-term interest rates. So that yield curve inversion can be very tempting because right now I think California Class, that's a PTA managed fund, as you know, I think is on a daily basis yielding 5.4%. And some of the other, the yield to maturities on the longer term portfolios like your 1 to 3 and 1 to 5 are down around 4% currently. And that's because those longer term rates have already shifted lower in anticipation of the Federal Reserve stepping in and beginning to cut overnight rates. So the next FOMC meeting is scheduled for September 18th. The market is anticipating the Fed to start cutting those short-term interest rates. The key question right now is, are they going to cut by 25 basis points or 1/4% or 50 basis points, 0.5%? And once they begin cutting those short-term interest rates, those LGIP yields will move lower basis point for basis point over around a 30 to 40-day period as we're reinvesting into the now lower interest rate environment because of those Fed rate cuts. So the 5.4% is a very high yield today. At the end of this month, those yields will be lower for all local government investment pools because the Fed will start cutting short-term interest rates. And so I think that the primary determination I would say for this committee to make in deciding whether or not to keep that money invested in liquid products like the local government investment pools or consider investing it in your longer term 1 to 3 or 1 to 5 strategies really comes down to your liquidity needs. If it's not money that you need foreseeably for any particular reason in the next couple of years, it could reasonably be invested in the longer term portfolios. Alternatively, if you don't have that visibility, one of the things we might recommend is redoing a cash flow analysis. That's one of the things that we worked with staff with when we were originally hired, is to do a cash flow analysis, look at your expected revenues, expenditures over the next 12 to 24 months, and really determine how much liquidity you actually need. And as a result of that original analysis, the 1 to 3 and 1 to 5 portfolios were structured to leave an amount of liquidity that was consistent with your cash flow needs, and the excess amounts were invested in the 1 to 3 to 1 to 5. So that's, I would just say that the primary consideration for you all is really based upon your liquidity needs. We can't tell you which strategy is going to outperform in the near term, which is going to do better. Certainly the yield in the local government investment pools is much higher today at 5.4% in my example, but that's because the market in 2-year, 3-year, 4-year, 5-year treasury securities, for example, have already priced in several hundred basis points or percentage points of interest rates cuts coming from the Federal Reserve. So even though there would be a yield to maturity give up, the total return on those strategies could be greater than leaving them in the local government investment pool once the Fed starts cutting interest rates, because we don't know how far they're going to cut them. And so I would just say, really, your decision, interest rates is one consideration, but I would say the primary consideration would be your liquidity needs and whether or not you need that money liquid, or if you could reasonably be investing it a little bit further out the yield curve in pursuit of those higher returns that are going to be available over multi-year periods in those longer term strategies. They don't always outperform, and I think 2023 was a great example where cash products were some of the highest returning fixed income investments. That's not typical. Typically, the longer maturity, longer duration profile strategies return greater, but that was really a function of how aggressively the Fed moved to raise interest rates. So I've given you quite a bit to chew on there, and I'm happy to address any questions that might be helpful for you all as you're kind of making these considerations about whether or not and where to potentially move that 30 million of excess funds from life.
Okay, well, I would almost say as far as our needs, we are covered for a while. And as long as we still have the California Trust and the Cal Class, that's always available for us to transfer into our operating account if first something happens or we need it. So I would almost say anything that's in LAIF could easily be moved out over to Bank of New York and it won't interrupt any of our daily business processes.
How would that affect if we get a big loss?
That's exactly. what I was
You know,
thinking.
I might make one observation here too, and that is just your investment policy limits the amount that you're allowed per state statute to have in money market mutual funds to 20% of your portfolio. So I think we would just want to kind of math it out to see what amounts, would ultimately be in the money market fund to make sure that as a percentage of your total investment program, that it was not a breach of that 20% limit, which is a state code limitation.
So how do you feel about that, Mark?
Well, I think there is a risk, there's an exposure above $25 million. So we're in a different environment, Mark, this year versus last year. We had a $50 million layer of coverage. So we are today responsible for the first $6 million of any law enforcement related claim and $2 million of any other claim. That's up from $250,000 the prior year. And we have now exposure over $25 million versus $50 million last year. So our insurance posture has really changed. So I think there is, we set that 25 million based on prior experience with cases, and we did have about a $25 million case 10 years ago, 5 years ago, 5 to 10 years ago.
That was, probably about 5 years ago.
So it is technically possible that we would have exposure in the 25 to $50 million range that we would be entirely responsible for in the current fiscal year. It's too early to know how things are going to turn out in the current fiscal year, but one case changes everything. And we have just over $50 million of undesignated, available fund balance, right?
Or unassigned?
Unassigned.
No, it's not.
It's a little bit less, but we can
Yeah.
pull back on certain commitments if we needed to, if we wanted to. But the general fund reserve, when we take out the one-time investments, is in the low 50 million. It's about 54 million, $55 million.
As of June 30th of 24. We don't, those are just estimates at this point,
Estimates.
yeah.
You're in projected close of
Yeah.
$6 million of excess revenue.
Excess, yeah.
Over expenditures, so we're anticipating closing 23-24 with $6 million of excess revenue over expenditure, which is really helpful in an environment where we're deploying about $9 million of one-time money in the current year. So this really helps because we weren't really necessarily counting on anything, right, when we built the budget.
Mhm.
But I think we definitely have more exposure moving forward.
Yeah.
And I think we have to be prepared for, 20 to 25 million dollar problem.
Now, if we left Cal Trust and Cal Class, that's 30 million there, and then if we moved out 30 million from Life, that still leaves about 23 million. So, and that's liquid. So if we wanted to funnel that 30 million from Life to Bank of New York to invest, I feel that's reasonable to go with that and still have that liquidity there in case there's any kind of lawsuits that do hit the city.
I like the idea of locking in a few longer term, better interest rates over a 3-year horizon if we can, to take advantage of our significant reserves. As long as we feel like we can cover that delta on the worst case scenario, if there's some form of a claim of significance.
Because right now the long term is lower interest, but when the Fed lowers interest rates after interest rate, which he's talking about, then it might not be a gain anymore.
Mhm.
So, it might, I agree. It might be good to lock in some longer term.
And I think we could work with public trust advisors to craft a an approach that balances the our risk exposure, and the timing issues related to,
If a lawsuit comes about.
right, and litigation type of exposure, as well as, anticipated changes in the market conditions. And that still diversifies everything in compliance with regulatory mandates.
Mhm. Would that work with you guys, Mark, to work
yeah.
on something like that?
Yeah, no,
Okay.
it most certainly would. And what I would just also add for the committee is, putting the money in the 1 to 3 or the 1 to 5 strategies, they are still liquid funds. The securities that comprise that portfolio have very active liquid secondary markets. If we needed to sell securities in the open market, we could certainly sell them at any time. It's just with those longer duration strategies, you have a little bit more interest rate risk, which means the potential of selling those investments at a price greater than or less than par becomes greater because they're more sensitive to interest rate changes, whereas the short-term funds have less volatility associated with them. But I just wanted to reiterate that the securities that comprise those portfolios are still very liquid. We can access, capital on behalf of the city anytime a need should arise because the securities are so liquid. And I would just further add, I'm going to foreshadow a little bit of my portfolio review, but also just because of some of the changes in the interest rate environment, both of the 1 to 3 and the 1 to 5 portfolios right now are trading much closer to their par values than they were 6 months ago. When the Federal Reserve, as you all know, raised rates so aggressively, 525 basis points or 5.25% over the course of 13 months, that caused the market values of your longer strategies, the 1 to 3 and the 1 to 5 in particular, those market values declined. Well, because the market has now been pricing in expectations of interest rate cuts, interest rates have declined, which means the market value of the securities in your portfolio have appreciated significantly. And so they are now trading much closer to the values at which they were purchased, meaning, the gain loss is very close to zero on a net basis. So we're almost back to par. In fact, I think in the aggregate, we're trading a little bit better than your original cost value across both programs, the 1 to 3 and the 1 to 5. And so that means that anytime you needed to pull money out of the 1 to 3 or the 1 to 5, we could identify a basket of securities to fund that liquidity need currently that would result in no realized losses on any of those transactions. So I just wanted to reiterate, they're still liquid strategies. It's just the price at which we can liquidate is a little bit less certain and a little bit more volatile. But yes, we could certainly accommodate, and we would work with you all to determine if the dollar amount we're talking about is 30 million, we could work with you all to determine how to split that between the 1 to 3 and the 1 to 5. What originally comes to mind would just simply be a pro rata based upon the current balances in the 1 to 3 and the 1 to 5. Just take the appropriate percentage, apply it to the 30 million, and fund that amount into the 1 to 3, fund that amount into the 1 to 5. And that keeps those two portfolios proportionate to what City Council had originally authorized. So we can certainly reach back out and work out those details if that's the direction that you all decide that you'd like to pursue.
That's good.
Yeah.
Okay, we will do that.
All right, very good. We'll be in touch over the next week or so.
Okay, sounds good.
Okay. Any other discussion before I jump into our materials for today?
I don't think so.
Okay. Well, what I thought I would do is just provide a brief update with respect to the portfolio market conditions, kind of what we're seeing. A lot has changed since our last meeting, as I just foreshadowed. I think there was also a request for us to kind of go through a high-level review of the reports to kind of give a sense of what each data point means and how to interpret it and what it means in the context of the overall investment program. So I think what I'll start with is just a brief update on the market backdrop. And as I mentioned, a lot has changed since our last discussion, most of that having to do with the Fed. And out of respect for your time, I'll keep our economic update comments relatively brief because I really want to jump into the meat of the portfolio review, as well as a review of the reports. So you all can get as much mileage out of that material as is possible. But briefly speaking, the U.S. economy has continued, and we sound like a broken record at this point, but the resiliency of the economy's performance has been noteworthy. Subsequent to the publication of these materials, we did get a second update to the second quarter GDP forecasted results. So they were originally estimated to come in at a 2.8% annualized rate in the first quarter. That was actually revised higher, up to 3%. So we saw a bit of a slowdown in the first quarter's performance, where growth came in at below expectations, 1.4%. We've since recovered from that slight slowdown in the first quarter pretty substantially, again, growing at a 3% annualized rate in the second quarter. A lot of that having to do, again, with the resiliency of the consumer, which per the revised numbers actually grew at a 2.9% pace in the second quarter and contributed almost 2% of the 3% total growth for the period. So despite all of the concerns facing and headwinds facing the consumer, which I'll speak to, the consumer continues to be very resilient, continues to do the heavy lifting for the U.S. economy, which resulted in that upward revision to the second quarter estimates. Looking out at the back half of this year, we do think that those headwinds, which I'll cover, in which include higher interest rates and a slowing labor market, will eventually begin to weigh on activity, and we'll see a little bit of a give back in the second half of the year relative to the second quarter's 3% growth rate. In terms of just broadly speaking, I think that the ISM indices provide a pretty good kind of summation of the macroeconomic backdrop. These are diffusion indices. They're calibrated such that readings below 50 denote contraction in the sector. Readings above 50 denote expansion. The manufacturing sector has been really heavily hurt over the last several years just by some of the developments post-COVID and some of the changes in consumer spending patterns. It's been below 50 for, I think 20 consecutive months at this point, and we just got revised numbers this morning, which showed yet another below 50 reading. We did tick a little bit higher relative to July's numbers of 46.8. I think we came in at 47.2 for August. But again, the manufacturing sector continues to face a lot of headwinds and continues to be in contractionary territory. Service sector has really benefited from a change in consumer spending habits post-COVID, but even at 51.4 through July, it is still, down at relatively depressed levels, and is bouncing around between that demarcation point between expansion or contraction. As we look out in the back half of this year, we just think that some of these headwinds that are weighing on the consumer and that are keeping some of these ISM purchasing manager indices relatively subdued is going to result in slower growth in the back half of this year. That being said, and in part, one of the reasons for the better than expected performance in the second quarter, as I mentioned, continues to be the resiliency of the consumer. We had a blockbuster retail sales report in July. Retail sales came in at a monthly growth rate of 1% in July. For context, what that means in the aggregate is that 25% of all retail sales in the last 2 years occurred in July of this year. So that is not a sustainable pace on the part of the consumer, which is one of the other reasons we think there's going to be a little bit of a payback in the second half of the year, because 25% of the last 2 years accumulated retail sales were spent in July. But again, we don't think that is going to continue. I think the combination of higher borrowing costs, which the Fed is getting ready to make less high, we think this a little bit later this month, but also the slowing that we're seeing in the labor markets is starting to accelerate. So we think those two things are going to be a headwind to such a robust pace of consumer spending going forward, which plays into our thesis that the economy is going to slow in the back half of the year. Another contributor to that thesis continues to be the fact that consumers are dealing with still very elevated prices. Even though the rate of inflation is coming down, the price levels are still substantially higher, as we all know, relative to where they were 3 to 4 years ago. And you're starting to see consumers turning to a couple of different sources to sustain spending, which again we don't think are going to be sustainable for a durable period of time. That is savings. So the consumer savings rate, down at 3.4% as a percentage of disposable income, is at some of its lowest levels in the data series going back to the early 1980s. And one of the primary reasons we think that the consumer is going to be a little bit less robust in the back half of the year is that as the savings gets depleted, income will become a primary driver of consumption. And with the labor markets slowing, we think that income component has some sensitivity or some risks to it, that consumers might begin to tighten the purse strings a little bit as the labor market gets a little bit less robust and consumers have a little bit less confidence in their employment outlook in the back half of the year. And I'll come back to that point in a couple of slides when we talk about the labor markets. In addition to savings, consumers have clearly been turning to the credit card to sustain spending levels. On the left-hand side of this graphic, you'll see total credit card balances, which eclipsed 1.1 trillion through June. This data is available on a quarterly basis. So we'll get an update later. I think it's in October when we'll get the September update. But in addition to depleted savings, consumer credit card balances are at all-time highs. So the use of credit cards, in addition to those savings to help sustain spending as prices remain very elevated relative to levels from the past 3 years. Painfully, these record high credit card balances are occurring at the same time as record high credit card interest rates. I think the average credit card interest rate, according to Bankrate, just eclipsed 21.5%. And so you're starting to see those pressures build on the consumer. And we focus on the consumer a lot because the consumer represents about 70% of US economic activity. Over a long period of time, they contribute about 70% to total US GDP. So you're seeing the stresses of those higher credit card balances and higher credit card interest rates manifesting in rising rates of credit card delinquencies. So the credit card delinquency rate for all bank cards is still relatively subdued relative to prior periods of past recession at 3.25% through the end of June. But for smaller card issuers or smaller bank issuers, which are those kind of defined in this data series as bank cards issued by banks that are not in the 100 largest banks by assets, their delinquency rates are at some of their highest levels in history, almost 8% delinquency rates. And I think this is a really interesting and relevant perspective that, in the inflation that we've seen over the past years has really disproportionately hit lower income households. Inflation is known to be a very regressive tax, and you're starting to see that manifest in these consumer strains for the lower income households amongst us. Unfortunately, we think these trends are likely to persist through the back half of this year and into early 2025. I mean, even if the Fed comes in and cuts interest rates by 50 basis points, 75 basis points. I mean, interest rates on credit card balances are still going to be, north of 20%. So it will bring some relief, but we don't think it's going to really slow the continuation of these trends in rising delinquencies, which is, again, just a sign of stress in the primary driver of economic growth, which is the US consumer. Labor markets to this point have been a primary pillar. That dynamic is beginning to change quite substantially. In July, we had a very weak payroll report where the U.S. economy added a well below expectations 114,000 jobs. Market participants were expecting something closer to 175,000. In addition to that, the unemployment rate rose much larger than expected, up to 4.3%. And so I think a combination of those things really brings into focus some comments that Chairman Powell made at his Jackson Hole remarks later in the back part of last month, and really brings into focus the rate cuts that we're expecting to occur here in September. So while the headline decline, or the headline miss, I should say, in payroll growth at 114,000 was just a substantial miss relative to expectations, we think more noteworthy perhaps was the unexpected 0.2% increase in the unemployment rate to 4.3%. Even though at 4.3%, it's very low by historical standards and generally still reflective of a comparatively or relatively tight labor market, it did result in the triggering of one of the most reliable recession indicators in the data series that we follow. This is the SAM rule. It was actually not found until I think 2018 by Claudia Sam, who was a researcher with the Federal Reserve. But what she found was a way to transition the unemployment rate to a coincident indicator as opposed to a lagging indicator. And so what the SAM rule basically tells us is that every time in this data series here, going back to the 1960s, every time the unemployment rate has risen by 0.5% or more relative to its lowest level during the preceding 12-month period, every time that condition has happened, the US economy has been in a recession. And so that rule was triggered with that increase in July's unemployment rate up to 4.3%, which pushed the SAM rule up to just above the 0.5% trigger that has been associated with past recessions. Now, past performance is no guarantee of future results, in case our compliance team is watching. But combined with a lot of the other data out there, it's just reflective of the fact that labor market conditions are softening. And in our view, that's likely to weigh on activity in the back half of the year. And it also when we consider the fact that inflation continues to move lower, the Fed is trying to get inflation back down to the 2% kind of target on a sustainable basis. We're heading in the right direction. We're not at the 2% target yet, but it's undeniable that labor conditions are slowing. Inflation continues to trend lower. Those two things, in our view, do necessitate the Fed to begin calibrating interest rate policy a little bit, beginning to cut interest rates. The Fed has a dual mandate from Congress, that is price stability and maximum employment. When inflation was going rampant in 2022 and 2023, they clearly lost control of the price stability mandate. So they had to lean into higher interest rates to try to tame that runaway inflation. But now we're starting to see labor market conditions slow quite substantially. That SAM rule has been triggered, and inflation is moving down in a sustainable way, not at the 2% target yet, but we think the fact that labor markets are softening and inflation has made a lot of progress, it is now appropriate for the Fed to better calibrate policy to our current economic realities and take a little bit of bring a little bit of relief to interest rates, and really brings into focus again that September rate cut that we're expecting, the magnitude of which really remains to be seen. But we would note, I think, a couple of takeaways from Chair Powell's remarks at Jackson Hole on August 23rd were, he said, the time to adjust interest rate policy is here, meaning we're cutting rates in September. He said the trajectory is clear, meaning we're going to begin cutting interest rates, and the magnitude and timing of those interest rates were dependent upon incoming economic data, the evolving outlook from the Federal Reserve, and the balance of risks between inflation and labor markets from the Fed's perspective. So they held rates steady at their July 31st meeting, but all eyes are now on the upcoming September 18th meeting. Market is expecting a full 25 basis point rate cut from the Fed on September 18th. There's implied probabilities of around 40% of a second 25 basis increment, meaning perhaps the Fed might go 50 basis points or a 0.5% cut to short-term interest rates at that meeting, just because of that really softer than expected labor market report. They may want to get out ahead of further labor market softening. And on that point, Chair Powell at, again, the Jackson Hole meeting said, and I'll paraphrase, but I think it's an important quote as we consider the upcoming interest rate cut from the Fed. He said that they no longer desire nor welcome additional softening in labor market conditions. So in our mind, that kind of sounds like the Fed may want to defend that 4.3% unemployment rate, which perhaps suggests that first rate cut could be a 50 basis point variety, as they don't want to see any further weakening in labor market conditions. They might feel as though they've overstayed their welcome at the 5.5% short-term policy rate, and try to bring that back down to prevent further softening in labor market conditions. So what we see here is just a change in the Fed funds futures market. It's basically just a market where investors can buy futures contracts based upon where they expect the federal funds rate to be at different points in the future. The key takeaway here is simply, following that weaker than expected July jobs report, the market basically priced in between 60 and 40 additional rate cuts coming from the Fed. So whereas before they were expecting maybe the Fed would not have to be so aggressive because a lot of the economic data had been more resilient than expected, that soft labor market report, now coupled with Powell's comments about not wanting to see any further deterioration, the market has again begun to price in expectations of more aggressive interest rate cuts coming from the Fed. And in fact, if we look out to December of 2024, the implied policy rate is 4.35%. That's over 100 basis points, or a full 1% of interest rate cuts baked into market participants' expectations between now and the end of the year. And so one of the interesting things, and we've talked about this in past calls, is as we move out the yield curve, right, 1 year, 2 year, 3 year, 4 year, 5 year rates where the city's portfolio is invested, those rates don't act when the Fed actually cuts interest rates. They begin to price in those expectations of interest rate cuts well before the Fed actually begins to cut interest rates. And you can think about the reasoning for that, right? If 3-month rates are 5.5% and 2-year rates are 5.5%, but the market thinks the Fed is going to cut by 50 basis points in 6 months, well, market participants are going to go out and start to buy the 2-year treasury because they can lock in that 5.5%, while the Fed is expected to cut the 3-month rate by 50 basis points down to 5%. So they want to, it increases the demand for those longer duration securities, pushes their price up, pushes their yields down, which is why we see, based upon those changes in the expectations for how aggressive the Fed is going to cut interest rates, the yield curve has already shifted lower. So just relative to about a month ago, relative to when these materials were published, we saw the curve shift down by between 30 to 50 basis points in anticipation of those interest rate cuts to come. That has had it's a double-edged sword, and we'll talk about that when we get into a review of the portfolio. On the one hand, we want to be reinvesting into higher interest rates. On the other hand, when rates decline, that means the market value of your portfolio increases. So we'll touch back on those points when we go through the portfolio and report review. Okay, and so that is, I guess, concludes our remarks on the market, and I'm going to transition to a kind of a discussion on the portfolio. And I thought we could kind of kill two birds with one stone. So as we do a review of the portfolio, I'm going to use your statements as the foundation for that discussion. So we'll talk about the key characteristics of the portfolio as we go through that review, and then I'll also go through the different data points that are contained in the report to help address kind of that request for a high-level kind of review on how to read and interpret the reports. But before moving on to a review of the portfolio and the reports, any other questions or comments regarding the economic or market outlook?
No.
No.
All right, I'll stop there then, and I'm going to switch my screens up here. And I'll start with just a review of the 1 to 3 portfolio. I probably could have kept that share in. Okay. And so, yeah, I'll just start with a review of kind of the portfolio. And as I do that, I'll talk about kind of the key metrics that are included in the report and how to interpret them. And I'm certainly happy to take your questions along the way. So please feel free to interject if there's any questions as we go along. But just from a characteristics perspective, we did increase the portfolio's duration, its interest rate sensitivity in July, which turned out to have been a very good decision as interest rates declined. So the duration was increased to just over 1.8 years from 1.67 years at the end of June. Recall that what duration tells us, it's the interest rate sensitivity of the portfolio. It is very closely related to the portfolio's average maturity, but it tells us a very specific thing. Duration tells us if the yield curve were to change by a full percentage point in either direction, the market value of the portfolio would decline in percentage terms by the duration amount. So a duration of 1.8 means that if interest rates fall by a full percentage point, then the value of the portfolio increases by 1.8%. And vice versa, if interest rates rise and the duration is 1.8, the market value declines by 1.8%. So it's a very important metric that helps us to kind of gauge the level of sensitivity of the portfolio's market value to changes in the general level of interest rates. The years to effective maturity and years to maturity are substantially the same thing. The final maturity relates to the security's legal final maturity date. There are security types, for example, like mortgage-backed securities or other amortizing structures like asset-backed securities, where there are prepayments happening on the underlying loans, which causes the security to mature in advance of its legal final maturity date. If there were any securities in the portfolio that had those prepayment characteristics, you might see a greater differential between the effective maturity and the final maturity. But because the portfolio does not currently contain a substantial allocation to any of those types of securities, those two metrics are going to be substantially the same. And I should note that in terms of the characteristics, these are all weighted averages based upon the individual market values of the individual securities that comprise the portfolio. So the coupon rate, as we know, fixed income securities pay a coupon. Generally, it is semi-annual. It can be monthly, it can be quarterly, it can be weekly in some cases. The securities in the city's portfolio pay semi-annual coupons. So the coupon rate just reflects the weighted average coupon amount that is paid semi-annually by the securities in the portfolio. And here's where it gets a little bit more fun. So the book yield and the market yield. The book yield reflects the weighted average yield based upon the purchase price of all the securities in the portfolio. So that's going to give you a pretty decent indication of the run rate of the income being generated off the portfolio in annualized terms. So the book yield on the portfolio, because we have been rebalancing, as you know, selling those shorter term securities that are now remaining terms to maturity of less than 1 year, reinvesting them back out to the back end of your maturity distribution to maintain that kind of targeted duration and maturity profile. as we've been selling shorter term securities, lower yielding securities, and buying today's higher yielding securities, the book yield on the portfolio has been increasing. So over the over the month of July, it increased, call that about 17 basis points, up to 4.13%, as we took advantage of those rebalancing trades and bought higher yielding securities in the current interest rate environment. What is noteworthy, though, is over the same month, market yields declined very substantially. And you can see that reflected in the change in the portfolio market yield. So what the market yield is, it reflects the current yield to maturity of all the securities in the portfolio based upon their current market value. So you can think of it as holding all of the existing securities in the portfolio from their current market price through maturity results in the market yield. It is also the yield that if you were to sell this portfolio to a new investor in its entirety at its current market value, the new purchaser would be buying the current market yield on the portfolio, which is going to be different, of course, from the book yield that we've locked in at the time of purchase. One of the things I wanted to point out is because of that substantial decline in interest rates that we saw, in particular in July, the book yield and market yield of the portfolio converged. And in fact, right now they're within a quarter of a percentage of one another. As interest rates were rising so aggressively, that delta, that difference between the market yield and the book yield got a little bit wider because the Fed had raised rates so aggressively, and the book yield was lagging market yields because the Fed was raising interest rates. Well, these declines in rates that we've seen have caused that differential between a book yield and market yield to converge. And in fact, I will say, I'll come back to this point in a minute because I think I want to tie it into some of this other data. So as a condition of fixed income math, anytime your market yield is greater than your book yield, that means that interest rates have risen since the securities in the portfolio were purchased, which happens. They can also fall. But what that means is when the market yield is higher than the book yield, you have unrealized losses in the portfolio. That's because bond prices and interest rates are inversely related. When interest rates rise, the market value of previously purchased securities decline because investors are going to require a discount to buy those lower coupon bonds. And conversely, when interest rates decline, an investor will be willing to pay a premium for that bond you purchased with a higher coupon. So you can see that over the course of this month in the 1 to 3 year portfolio, your unrealized losses in the portfolio declined from just over $500,000 to now just below $50,000 in terms of the overall holdings in the portfolio. So I'll come back to that math in a minute, but that's the double-edged sword of falling interest rates, or rising interest rates for that matter. As interest rates decline, we're going to be reinvesting into now lower rates than were available a month ago, but the value of all the securities previously held in the portfolio are going to increase. So I'll just discuss in the context of the request to review some of the data points of the report. I'll go into a little bit more detail on some of these in the 1 to 3, and then I'll just breeze through the 1 to 5 portfolio because we won't need to go into this level of detail about the different data points. The historical cost is simply the original cost of the securities held in the portfolio at each period end. The book value reflects the impact of amortization and accretion. So if securities were purchased at a premium relative to par, then that differential between par and its purchase price is going to be amortized down to par over the life of that security. So the book value reflects the amortized cost value, taking into consideration the net amortization of premiums and accretion of any discounts that were paid for the securities in the portfolio. The accrued interest simply represents the accrued coupons that are accruing in the fixed income securities, but because their coupon payment dates have not come yet, they're still accrued and payable on their respective payment dates. So that's the amount of accrued coupons in the fixed income securities at each period end. The net pending transactions, typically there won't be a lot of these unless there's transactions that were purchased at month end, but that settle in the new month. In this case, this pending transaction is just a money market fund dividend payable that had not yet been received on on June 30th. So the book value plus accrued is just that amortized cost value, adding back the accrued. The market value plus accrued is just the market value of all the securities in the portfolio, inclusive of the accrued interest amount. And the differential between the book value and market values is that unrealized gain loss number, which, as I noted, because of the decline in interest rates over the month, is now a tenth roughly of what it was just at the end of June. So that's the benefit of declining interest rates. And I would note that also subsequent to the July 31st, and again, to get the materials into the committee's packages by the deadline, we needed to provide it prior to the August 31st month end. But rates continue to decline all through August, such that in the 1 to 3 year portfolio right now, there is actually an unrealized gain of 259,000. So the unrealized losses are fully gone away that resulted when the Fed was raising rates so aggressively, and we now have a unrealized $259,000 gain through the end of August. And the nice part about these is that, as we've been doing rebalancing trades, selling out those lower yielding securities to take advantage of today's higher yielding securities, that has resulted in those realized losses that that are recognized in the accounting period in which the transactions are executed. So I'll just use the income summary as an illustration of that point. The interest income just reflects the coupon accruals that are occurring for all the securities in the portfolio. The net amortization and amortization or accretion income is just the net of the amortization of premiums or the accretion of discounts. So it can either be additive or subtractive to the portfolio's income. In this case, on average, securities were purchased at a discount. So we have accretion income, which adds to the portfolio's coupon accruals as a source of income. And then we have the net realized gains and losses. So in the month of July, we executed a couple of rebalancing trades to again, sell those previously purchased lower yielding securities, reinvest in today's higher yielding longer term securities. That did result in that $78,000 kind of accounting loss in that period. But the benefit is that those higher yielding securities that are now in the portfolio with maturities of between 2.5 and 3 years, they're going to be paying that higher rate of interest locked in over the course of their life. And as we now know, interest rates fell so dramatically in August that on balance, the securities in the portfolio now have a book yield that is greater than current market yields. So that means when we're doing rebalancing trades in the future, you're going to see recommendations that in many cases will have gains associated with the sale. And so those gains will be additive to the portfolio's income. Even though we are buying lower yielding securities, the gains will be accretive to the income in the exact same way, whereas previously we were buying higher yielding securities but had to sell lower yielding securities, resulting in those losses. So we're now getting into, you're getting the other side of that fixed income coin as we're going to be rebalancing trades into a declining interest rate environment where there will very likely be realized gains that will be accretive to the income. And then here's just a summary of the asset allocation by investment type. Right now, we are light on corporate bonds. We would expect to be adding to this asset class as we move through the remainder of this year, as we expect their spreads to get a little bit more attractive relative to Treasury bonds. They got a little bit wider in the immediate aftermath of the weaker than expected July payroll report, but they snapped back in and are trading currently at some of their lowest levels relative to Treasury securities in the past 2.5 years. So given our outlook that the economy is likely to slow, that corporate earnings are likely to face a little bit of pressure in that slowing economic environment, we think that corporate bond spreads are going to get more attractive as the year progresses, and that would likely be an asset class that we would be buying into as we saw incremental widening of their yield spreads relative to Treasury securities. So perhaps just a little bit of foreshadowing of some of the recommendations to be coming as we see those spreads begin to widen. We're getting more compensation for taking on the corporate credit risk, better what we call relative value, better balance between the risk and return that is being offered by those security types is something we would likely be adding to in the back half of this year, should we see those spreads widen as we do anticipate. So this is a high level kind of overall summary of the overall portfolio. Before I move on to some of the other pages, anything you would like me to go into more detail on here? No. Okay, so then just moving on, here's a quick distribution of the securities by maturity type, by maturity and security type. So in this case, we've got your certificates of deposit, the corporate bonds, your money market fund, and then the U.S. government securities. And these are grouped up by maturity bucket. So each asset class, this tells us the market value that is maturing in the next 0 to 3 months, 3 to 6 months, so on and so forth. As these securities roll down the yield curve and mature, very often we won't sell the CDs or the corporate bonds as they age through the portfolio. They tend to be smaller percentages of market value. So we tend to let those age through the portfolio. You don't really get very good pricing when we're selling, $240,000 CD positions. You take a big hit on the market pricing to liquidate those. So rather than use those to rebalance, we let these positions kind of mature and then add some treasury sales, for example, to help rebalance the portfolio's maturity profile. But typically, in your 1 to 3 year portfolio, the majority, and as is the case here, the majority of your market value is by design going to be allocated between that 1 and 3 year maturity point on the yield curve. So this just gives us a breakdown of security type by maturity bucket, by market value of the distribution within the portfolio. And that's just represented graphically here. And then you just have a quick summary of the top 10 kind of holdings within the overall portfolio. On the next slide, this is just going to give us a review of the ratings by S&P and Moody's. I'll just use S&P as an example. So this just shows us, the dollar amount and percentage of the portfolio that resides in the different rating categories. So the key difference, we've talked about this in the past, between Moody's, which has the AAA, which has the 50 million in AAA, versus S&P, which has that in the AA category, is that back in August of 2011, S&P downgraded the U.S. sovereign credit rating, which is a flow through to U.S. Treasury securities and agency securities, to AA+ from AAA. So they're in the AA ratings category, whereas Moody's still rates the U.S. sovereign in the AAA category. So that's the primary difference you're going to see. And then we have, what percentage of the portfolio is in single A rated securities. And then, I keep on clicking the wrong button. Oop, I jumped ahead. What percentage is rated below A and what percentage is not rated? Do not be alarmed by the below A or not rated. These are certificate of deposit positions, which may have ratings that are below A or in some cases may not be rated, but their individual par amounts are below FDIC insurance limits. So they effectively carry the same credit quality as the U.S. sovereign in this case. But those are certificates of deposit that are issued by banks that don't have ratings above single A or may not be rated at all. But because they are covered by FDIC insurance, there's no credit risk associated with them. They're effectively fully guaranteed by the U.S. government. Okay, on the next slide here, this is just going to be a good, useful way to kind of look at any changes in asset allocation that have occurred over the period. This could be monthly, as in this case, it could be quarterly or any other time period that we wanted to look at. But this is just going to show us the market value and percentage of portfolio in each of the different security classes at the end of each period. And so here you can see in July, we did lighten up on some of the U.S. agency securities. So we sold 3.5% of U.S. agency securities to help rebalance the portfolio's duration. The reason we sold the agency securities is U.S. agency securities right now are trading with yields relative to U.S. Treasuries, which are full faith and credit of the federal government. The instrumentalities or GSEs are not full faith and credit. Their yields are right on top of, or in some cases actually even below, U.S. Treasury ratings. So as a result of that, rather than sell full faith and credit securities at the same yield, we chose to sell the federal instrumentalities because we got effectively the same pricing by selling non-full faith and credit securities. We also had some accumulated money market fund balances that were used and reallocated into the Treasury sector over the course of the month of July. So this is just a good way to kind of see the change in both dollar market value and in percentage of portfolio terms, the changes in your asset allocation from period to period. And it also is just, again, reflected graphically here at the bottom of the page. The next page is really just the same information. Some clients like to look at it based upon cost. Some like it based upon market value. So our reports include them both. It's the same analysis, just whether or not these values are based on market value or on cost value. So I won't spend any time being redundant with those. And here, now we're going to get into a little bit more of the meat of the report. And so I'll just go through, I'll pick one security and I'll just kind of walk through each of the data points here along the top. It's stacked information, so it gets a little bit confusing, but once your eye kind of learns to kind of navigate the page, it becomes a little bit more intuitive. On the left-hand side here, this is really just the security description telling us this is a U.S. Treasury security. Here's its CUSIP or identifier, its coupon rate of 5%, its effective maturity and its legal final maturity and its duration. So we have effective maturity, final maturity, both the same at September 30th, 2025, and its duration is 1.1 years. This is going to tell us the trade date and settlement date when the security was originally purchased, the par amount of the security. The top stack here is the security's original cost, so based upon the original dollar price paid. The book value, this is the amortized cost value of that security as of the 7/31 reporting date. Here is the market value of the position based upon its 7/31 market price of par spot 37. And that par value times the market price is going to give us this market value of 1.48 million in this example. Here we're just taking the market value and adding back to it the accrued interest. So we have the market value plus accrued, and then this is just breaks out what the accrued balance on that security is. Again, that accrued just represents since the last coupon payment date on this security and the reporting date of 7/31 at 5%. At this par amount, the math is simply the 1.475 million times 5% divided by 365 times the number of days since the last coupon payment and the reporting date of July 31st. So it's the accrued but yet unpaid coupon. And then
Let us write down that equation real quick.
exactly. It just represents the accrued but not yet paid coupon payment in that security. And if we were to sell that security, you're entitled to that accrued coupon payment. So it gives you a better sense of the full value of that security because you're entitled to the accrued yet unpaid interest. And then your unrealized loss just represents the differential between the market price and the book value. So that's that unrealized loss. And that's the delta between, again, the market value minus the book value of the security. This just shows as a percentage of the total portfolio what this position reflects in terms of its contribution to the total portfolio. So this position is 2.73% of the total portfolio. Obviously, because these are full faith and credit U.S. Treasury securities, we're very comfortable holding larger allocations to these. Our allocations to more credit sensitive sectors will be lower within the portfolio, of course. This is just an example. In some cases, bonds are callable prior to maturity. So if these bonds were to be callable, it gives us a flag of yes or no, whether or not the bond is callable. If it is callable, what is the next call date? And I'll just go to an example because a lot of corporate bonds are issued with call dates that occur within the last month or so before the security's maturity. So just to give you an example, I'll just flash forward here to the next page and just highlight some of these Eli Lilly bonds. So all the metrics here before are the same as we just discussed. But this gives us a flag that, yes, this bond is callable. Its next call date after July 31st of 2024 is January 9th of 2027. That happens to be 1 month prior to the security's legal final maturity date. So we typically do not carry high allocations to callable bonds in the portfolio because it creates uncertainty with respect to when their bonds are actually going to mature. It creates it creates variances in their duration that make it difficult to manage to a targeted duration profile like your 1 to 3 strategy. These types of callable bonds that have call dates within a month or 2 or 3 before their prior maturity dates are pretty standard. They don't introduce a lot of cash flow uncertainty to the securities structure. So I just differentiate these between, for example, an agency bond, which might be issued with 3 years to maturity, but it might be callable every 3 months by the issuer. We tend not to like those structures because your upside is limited to the call, to the premium, to the yield premium based upon the call, but your downside potential if interest rates decline is technically unlimited. So it's kind of an asymmetric risk return profile in our view. We don't tend to like that asset class, but we observe that these varietals of callables where the date is only a month away from their legal final maturity date do not carry the same risks. And they're very common for corporate bonds to include them just to help them with their cash management. So then to just round out some of the additional data points here, back up to our reference security. So we got the call flags, as we noted. The book yield is the original yield on the security based upon the price that was paid for that security. The yield to maturity or yield to market, YTM, reflects if we were to sell this bond in the current market today, this is the yield that it would be sold at. And again, I would just draw your attention to that mathematical, that fixed income math that says anytime the market yield is above the book yield, there will be an unrealized loss in the bond. That's the nature of fixed income securities. And then on your next August report, you're going to see these signs flipped, where the book yield is going to be greater than the market yield in many cases, and we'll have these unrealized losses flipped to unrealized gains. And then the last column just is a stack of the S&P and Moody's rating for the securities. So I'm not going to go line by line and do that for all the securities, but I wanted to just walk through each of these data points, give you a little bit more detail on what they all meant, and I'm happy to answer any questions with respect to the holdings. Okay, so then I'll just move on from the holdings and touch upon a couple of other components of the report. The next page is just the transactions. So as we do our rebalancing trades, this transaction section is where you'll see those. So this just gives you a summary of the bonds that were purchased over the period and the bonds that were sold over the period. So here you can see, I'll just pick the top one for simplicity. This just gives you the security type. It's CUSIP, the par amount of the bond that was bought or sold, the trade and or settlement date of the transaction, the price at which the trade was executed, be it a buy or a sell, the principal value, which is just the price times the par value divided by 100, to give us a sense of what the purchase price or the sale price of the position was, whether or not there's a realized gain or loss on the transaction. Of course, on the purchases, there's no realized gain or loss. On the sales, as we did note, there are some realized losses as we reinvest, or as we sell these lower yielding securities and buy those longer yielding securities at today's higher interest rates. So that loss over the period on those securities of 78,000, you'll recall that's the number from our income summary, I think is on the very first page of the portfolio summary characteristics. And this just shows who the participating broker dealer was to that transaction. And then the net amount of the transaction, which includes the principal amount plus any accrued interest on sale or upon purchase. And then the income report, this is going to show you the income on each security in the portfolio, and then of course it aggregates up to the total income number that will show on the first page of material. So I'll just go through again one security. Let's just pick a treasury security. Okay, so this first treasury security here is just again here it's a description of the type of security. It's CUSIP, so you can tie it back to other positions in other reports. The security's final maturity date, the par amount of the position. The interest income amount is going to be that formula that I gave you. That's the coupon accrual amount. And so it's going to be basically between the securities, relative to prior month end and July 31st, how much additional coupon has been accrued but yet unpaid on that security. If there was a transaction over the month, if there was a sale, and maybe I'll pick a bond with a sale. That'd be a better example. I'll just pick this treasury bond here in the middle. So we've gotten, so if there's a sale, it will show as current units as 0. The interest income is going to reflect the coupon accruals that occurred over the reporting period. So from July 1st to July 31st. If there was a transaction or a sale that resulted in a realized gain or loss, it's going to give you the amount of that realized gain or loss. It's going to give you the accretion income on the portfolio. If there was any amortization expense, for example, if the bond was purchased at a premium, that would show up here. Any miscellaneous income is kind of just a general category. But here, this net income number is going to be the sum of the interest income, the realized gain or loss, and the accretion income and amortization expense. So if you sum up those data points, that's going to be the security's net income over the period. And then it gets aggregated up for each security, obviously, and then in total for the total portfolio. So any questions on the interest income? Okay.
No.
And then here, this is a little bit of a redundant report, but there is the GASB 40, as you all know, requirements. And so we include a GASB 40 compliant kind of component to all of our reports. GASB 40 just sets forth certain information that is required to be disclosed regarding the investment program. So we include a GASB 40. It's really just a reformatting of the holdings report. There's not a lot of new information here, but I guess, comprehensiveness, we'll just pick these Eli Lilly bonds. I'm just going to tell you who the issuer is. It's the coupon on the bond, the security type, the percentage of portfolio market value, the security's book yield and its market yield, which we've discussed before, the security's duration, its ratings, and then again, that effective maturity date and its final maturity date. That we discussed before, the current par value or units of the security, the accrued but yet unpaid interest as of the period end, and then the book value and market value, both with and without accrued interest. It's just formatted in a way that there's a GASB 40 reporting requirement that wants you to kind of express the data in a certain way. So we had enough clients ask us for a report that provided the information in this way, even though it's kind of redundant with the holdings report. We provide it as part of our standing reporting package. It's just formatted in a way that's more intuitive relative to the GASB 40 requirements. And then here's a portfolio activity summary. This is a pretty useful report if you're doing when you're doing your monthly reconciliations. And so I'll just pick a security here. I just get down to maybe a treasury security since they're a little bit more straightforward. And so this is going to, and maybe pick a security where there is some activity actually. Yeah, okay, so let's do this bond. It looks like this is a bond that we may have sold over the period. It was. So this is going to be a good, useful tool when we're doing some reconciliations. So this at the CUSIP level just identifies as a U.S. Treasury security. Here's its CUSIP. Its sector is the U.S. government. The final maturity date of Jan 15, 2026. Here we have our stacked original cost values, beginning market value, and beginning book value for the security. And then here we will have, let's see, if there is any purchases, if a bond was purchased, like here's a bond that was purchased. So it has our beginning par value. Let me see if I can find a bond that was sold. I'm sorry, I'm jumping around a little bit, but I wanted to make this as useful as possible. I'm trying to find a trade with a realized loss. Okay, here we go. Third from the bottom, same information as before. Identifiers, maturity dates, stacked original cost, beginning market value, beginning book value, which are metrics we've already covered. If there's any purchases, if the bond was purchased over the period, it would show here. This was a sale, so it's going to show us the principal amount of sale. So this is going to be the par value of the bond times its sale price. And this is going to be the accrued interest, so that accrued but unpaid interest that was received as a part of that sale. And then if there was any maturities or pay downs, they would show up in this column. So a maturity is pretty standard, is the bond that matures over the period. A pay down might be something like a mortgage-backed security or another asset-backed security that pays partial principal payments as the underlying loans get paid down over time. If there's any pay downs, they would show up in this column. If there is any interest received, so in this case, we can pick a bond. There was some coupon payments received on some of these CDs in the various dollar amounts. So these interest received is going to be the coupon payments received. If there's any transfers in or out of the security, they would show up here. And then here we have any realized gain loss that results from a transaction or any unrealized gain loss at period end. So because this bond was sold, there was that realized gain loss. Oops. I'm doing that. There was that realized gain loss of the 26,000, but because the bond is no longer in the portfolio at period end, there is no unrealized gain loss associated with that position since it is no longer in the portfolio. And as a result of that, there is no ending original cost or ending market value or ending book value since the security was purchased. And that rounds out a pretty detailed review of the report. So I hope that wasn't too much information, but we did want to be responsive and do a quick walkthrough, and certainly happy to answer any questions that you have regarding the activity summary.
No questions.
Okay. So then we'll skip or we'll jump now to just a review of the 1 to 5 portfolio. And we're not going to go through that excruciating detail. I'm just going to touch on the highlights of this portfolio, since I think you all have a pretty good understanding of the different data points now. So in the 1 to 5 portfolio, we also did extend out the portfolio duration from 2.4 years to just under 2.58 years at the end of July. So the years to maturity on this portfolio by design are going to be a little bit longer at 2.76 years, up from 2.59 years at the prior month's end. As I noted with the 1 to 3, given the change in the interest rate environment, that's modest extension has paid dividends in terms of how the portfolio's market value has performed, even relative to what we're seeing as of July 31st. And I'll come back to that point. But again, here, the differential between, we did see an increase in the portfolio's book yield over the period. Market yields, as we discussed, did decline in the 1 to 5 year space a little bit less dramatically than in the 1 to 3, but still around a 45 basis point or so decline in interest rates, which did cause that unrealized loss in the portfolio to go from just under 900,000 to just below 500,000. So not quite a halving of that loss. Recall that the unrealized losses in the 1 to 5 portfolio are going to be greater than those in the 1 to 3 because it has that longer duration profile. So as the Fed was raising rates by that 5.25% over the course of 13 months, the 1 to 5 year portfolio, because its duration is greater, is more sensitive to the effects of those rising interest rates. So its unrealized losses are going to be a little bit greater. But given the decline that we did see in July, that did decline to just under 500,000. And I would note, just for since we did the same metric for the 1 to 3, as of August 31st, this 489,000 unrealized loss in the 1 to 5 year portfolio came down to 233,000 unrealized loss. So when we net that against the 259,000 unrealized gain in the 1 to 3 year portfolio, the overall kind of aggregate 1 to 3, 1 to 5 year portfolio is now, as of at least August 31st, was sitting with a roughly $25,000 unrealized gain across both programs. And I think that kind of speaks very importantly to, there was discussion about the importance of diversification. Diversification is not just something that is important in terms of the different sectors and credit qualities in the portfolio. It also is diversification along the yield curve. So when the Federal Reserve raised rates really aggressively, the 1 to 5 year portfolio got hit harder because it was a longer duration portfolio. But as the Fed had raised those interest rates, the 1 to 3 year portfolio was able to reprice more quickly into that higher interest rate environment. And so its book yield and market yield converged a lot more quickly because its shorter maturity profile allowed it to reprice into today's prevailing higher interest rate environment much more quickly. And so now we have this benefit because the 1 to 3 was less sensitive. It's now setting on an unrealized gain that is larger than the unrealized loss in the 1 to 5 year portfolio. So they're very complementary. They provide good diversification along the yield curve. And I think that's a really important point to just keep in mind, is that diversification includes not just by asset allocation and security types, but also along the yield curve, because the yields, different points along the yield curve do not move in the same increments. They twist and they turn, and they can invert and uninvert. And so having a diversified exposure to those helps diversify the overall program as well. So interest income summary here, we've gone through this already, but the components of that, we had coupon accruals of 79,000, net accretion income of 18,000, offset by some of the realized losses in terms of rebalancing, but that net income over the month of $72,500. Here we've got a breakdown of the portfolio's asset allocation. The primary difference between the 1 to 5 and the 1 to 3 is the 1 to 5 has some still owns some GSE or agency securities that were purchased when we originally structured the portfolios, back when that sector had positive yield spreads relative to U.S. Treasuries. And so those securities have aged out of the 1 to 3 year portfolio for the most part, but we still do have around a 10% allocation to some slightly longer maturities in the 1 to 5 portfolio, but they were purchased in a different environment when they had a slightly more attractive yield spread versus comparable U.S. Treasury securities. But good diversification across the 1 to 5 year portfolio as well. Here again, we're just looking at the maturity distribution by security type. I won't go through this line by line. You've had some time, I think, to spend with the materials, but by design, the bulk of this portfolio is going to be between that 1 to 5 year portion of the yield curve. This portion right here is kind of additive to your 1 to 3. So you've got just under 6 million of market value in that 3 to 4 year bucket, and just over 8.5 million of market value in that 4 to 5 year maturity bucket. So that kind of complements the 1 to 3 by providing a little bit more exposure to these longer term maturities that are not obviously available in a 1 to 3 year strategy. And here's just again a graphical representation along with a summary of your top 10 holdings in the 1 to 5 year portfolio. Again, ratings distribution, the portfolio is very highly rated, of course, with the high allocation to the government sector. Even the corporate bonds in the portfolio are very highly rated, consistent with your investment policy and state statute for both the 1 to 5 and the 1 to 3. I should also pause and note, we talk about the ratings. I also want to confirm, as we always do, the portfolios are in compliance both with the city's investment policy and the California Government Code. Again, don't be alarmed by the not rated portion of the 1 to 5 year portfolio. These are also some of the certificate of deposit positions that just are not rated, but in the individual par amounts are below FDIC insurance limits. So they are fully guaranteed by the US government, same credit quality as US Treasury securities. And here is just going to be, again, a change in market value in the portfolio over the period in terms of the distribution between different asset classes. So this being the July month. Here we did use some corporate bonds to rebalance in the 1 to 5 year portfolio. So we had 2.63% of corporate bonds that were used to rebalance, and along with a couple of other money market fund proceeds were reinvested into the US Treasury sector just to help rebalance the portfolio's duration. But largely not a significant change in the portfolio's asset allocation over the period. And just a graphical representation of your asset allocation by market value between the periods here. Same information here on cost, which is a little bit redundant, so I won't go into that. And then you're all familiar with the portfolio holdings, so I won't go into that review of the holdings as we went through in the 1 to 3. But again, here, happy to answer any questions with respect to the 1 to 5 or the 1 to 3 for that matter.
No. It's a lot of information, Mark.
I know. And
But we're not having a test.
I know. Well, listen, I mean, as you all are going through your review of the reports, don't hesitate to reach out to us. That's why we're here. So if as you noted, it's a lot of information to go through. There's a lot of detail. And if you're not looking at this stuff, it looks like the Matrix, right? Like for me, I can see it, but you guys aren't looking at this every day. So we're happy to address the questions, happy to take the time to walk you through it. If you find you have questions, after this call or at any time, really, just reach out to us, let us know. We want to make sure that you're kind of fully aware, have full transparency, and understand, everything that we're providing to you in terms of the report. Since it's your program, we want you to be understanding and comfortable with it. And to that end, and Mark, I'll just foreshadow a little bit here. We are coming up to another rebalancing period. So it's very likely the first half of next week, we'll be reaching back out with some additional rebalancing trades. And so I just want to put that on your radar and confirm that you'll be around, the first half of next week, say Monday through Wednesday.
Let's make sure it happens before Wednesday
Okay.
afternoon, because I'm going to be out for a couple weeks after that.
All right, good for you. Well, I hope it's some good vacation time, and we'll be sure to get something in front of you before Wednesday. Probably will be Tuesday morning at this point.
Thank you.
All right, wonderful. Well, are there any questions in conclusion?
No.
Okay. Well, thank you all very much for your time. We really appreciate it. And please don't hesitate to reach out if anything comes up or if you do find yourselves having any questions.
Thank you.
Thank you, Mark.
All right, thank you all for your time. Appreciate it.
Thank you.
Bye-bye now.
Bye-bye.
Moving on to item 6, the consent calendar. Item 6A is approval of the minutes from January 22nd, 2024. Any changes to those, or otherwise I'll take them.
At all.
Oh, I saw it
You saw
before. Yeah. I didn't see anything in there.
I'll make a motion to approve.
I'll second it.
Do we need to do a roll call or? Yep. Okay.
Yes.
Yep.
Okay. Chair Kendrick,
Yes.
Vice Chair Peterson,
Yes.
Treasurer Dealman. City Manager Mark,
Yes.
Sure.
The
yes.
AC to me, predict, okay.
Item 7 is were any reports?
Nothing?
None?
No reports. The only thing is that, for future meetings, I would like to try and at least target maybe, what do you think, the end of December? Would that be,
Before the end of the year.
so before the holiday?
So I'll be gone for like 2 weeks, but I might be available.
Oh, okay. When is your, when are you gonna be out?
I'm gonna be out. I mean, I can be available remotely, but I will be out of town from the 20th until the 6th.
Okay.
That's,
I'm gonna be going for a week too, kind of in that same area, so.
Yeah, we can target for maybe
Or-
beginning of the month.
Yeah, that would be good.
And I didn't see an email come through when this agenda was available. Did I miss that?
I didn't see it either, yeah.
I'll have
I didn't
to,
look to see when it got online, but it's been online for a while.
okay.
Yeah,
Well, I know typically like the city clerk lets us
Yeah.
know when the city council or
Yeah.
when DRC or
Okay.
planning
yeah,
commission.
yeah, I had to look for it too, yeah.
So-
Yeah, it'd be nice to see it's out there.
Yeah,
With nothing else, I will adjourn this meeting at
I would
5.
like to, could I make a comment?
sure.
What I'd like to see us do, and we don't get this from those reports, and we could talk about it some other time, more at length. We need to know what's invested in the fund total. Right? We need to know how much we've invested. We need to know in the last, say, 12 months or even 1 month, bi-monthly or bi-quarterly, what the income for that period of time was. And that allows you to see, it allows us to see what the rate of return is in percentage wise. So we can sit here and listen to this and look at all the charts, and they didn't have any charts today. But for quite some time, I've been critical of this particular presentation just because we didn't hear today those numbers as far as I know. What's the income that we've gotten from our investments over the last whatever period of time you want to plug in? And what was the rate of return? Now, if you look at this report 24-313 is put out, I brought it along today, which is part of our agenda. Right there, you can see exactly what we have invested and the rate of return. That's what you need. When I open my checking account, if I'm looking at my bank statement, I want to know the number. What have I got there?
Mhm.
And how did I get there? And that's what this is all about, but we don't hear where we're at. So did I miss that information today or am I?
We didn't go over the balance that's in the Bank of New York. It was more so the money market accounts, the LGIPs.
Well, I'm just saying, look, we're here to find out what the city has invested in the fund, what the return was. And then if you don't know that, if we don't know that, you can't compare it to other funds, other cities, for instance. You don't know.
Can I
Um,
suggest that in the next week or two, whatever time it takes to put together a report, you're familiar with the budget and brief type of approach. With large budgets distilled down to a single page or 2 or 3, right? That we put together a 1-pager, 2-pager, whatever it takes to show 3 years of data, probably with some graphs that show trends as well as actual data and performance along with year-to-date budget. Let's show the year-to-date budget versus actuals, but the performance over the last 3 years so that you have a sense of where it's been with numbers and percentages.
Well, if I go through his line by line investments and work out the numbers, is not a real great return, especially compared to what you have in short-term investments. I understand there's a difference, don't get me wrong, but there's a considerable difference if you look at the percentage the return rate that we're getting on a lot of those investments. Now, we're a lot better off than we were a year ago because of the reinvestments, that's true. Because interest rates have gone up. I mean, even this, you can see that right here. A year ago, or a year and a half ago, we were at 1%,
Mhm.
and not 5%, like we're seeing here. I understand that, but I'm just going back to my being redundant here. Those were the report we get right there. It doesn't allow us to compare against other cities, their rate of return, or other funds, other portfolios, I should, not funds, but portfolios. Does that make sense? Am I the only one that sees that?
And I don't know if we would really have the detail of other cities to compare to per se, and I don't know if that would be
I haven't
like,
checked either, to be honest.
I wouldn't,
But I would
I don't
say-
know if that's apples to apples, trying to do that methodology.
Well, it is in this respect, $100,000 investment or 100 million. What return did we get on that? Whatever the number was. What percentage of return, what rate of return was that? You know what I'm saying?
Mhm.
So it's just those top numbers that you have to start with. Now, how you got there is a whole other story. So if you look at the report that he was referencing today, if it's the one that I think that he was, that's a 66-page report. But right on the first page, you can't find, on page 22, you'll find some numbers about, some compiled numbers. That should be, that's my complaint. Look, you need to see it right up front.
We do
That's your starting
the summary pages.
There is a summary page on the monthly report, but those have been behind this year, and so I do apologize.
Well,
for
I'm not
that.
jumping on you guys,
Uh,
I think, because I'm blaming those guys. We're not starting there. If you're gonna start, if you're gonna have a report, I don't mean to drag on here, but if you're gonna start a report on the fund, the very first thing they should tell you is what you have invested in that fund. And then what your income was and how you got there. He'll pick individual securities and individual lines off of that, but he never gives you the full number. So I've been critical of them for quite some time, maybe unfairly so. But it's not our accounting here, it's them in their reports. So when I look at that, and I did, I pull his report and I look at it. Where do I find the information I'm looking for?
So you want a snapshot, kind of like right in the front?
Sure, I
When,
don't know what your rate of return is. What's the rate of return on that fund right now?
when we started with PTA, there was discussion, I wasn't involved in those discussions, but from what I know, about they create a special one-page summary for us that gets included behind my one-page summary on the monthly reports. And it has the balance in each type of fund. But it doesn't have the rate of return on here.
But you want it for everything, right, Dale?
So,
Well, you're looking at your fund, you've
You-
got how much invested, as I say,
like,
and
let me
then
go over and show you.
what was my rate of return?
Because
How much did I get back? What would my investment pay me?
So this is the one-page report that they customized for us.
Yeah, I know that, I
So
know that.
is this, would you just like a column added for like a
Well,
rate of
I'm not
return?
looking for you guys
Or-
to do that. Why are
No,
you?
this is, they provide this, PTA provides this, so we can ask PTA if they can add a column on here for rate of return, is that what you're thinking? Like
Well, you've heard my
summarize at this
complaint.
level?
Tell me where I'm wrong.
Well, if they're showing
Where
us
do we
the
have it?
balance that's in there currently,
Yeah.
I mean, that's being provided, it's just
Yeah.
the rate of return is
Okay,
not.
on
being
this
presented.
page right here, and I know that page, how much how much do we have invested in that fund right now? Is it that number right there?
So this number
Which you would
includes,
think is a combined combination of these two?
This number, so this total of 204 million includes all of their investments,
Yeah.
plus all of our investments in the LGIPs and, the money market account we have with Wells Fargo.
So how much money
Are
did
you
we give
looking-
them and how much did we get back? So if
Okay,
if I go down here, you've got it right here on your, these numbers right here. Here's what you've got in that. And here's your return rate right here. Now this is what you're gonna get paid. You're guaranteed that amount, of course. You didn't actually receive that yet, but that's what you're getting paid right here on that. How much is this fund returning? And that's part of
so
it.
that's kind of what I did here on this page, so this is what you want them to do maybe, so this right here, this section is the 1 to 3 per year portfolio. And so I've added on their, the rate of returns here, and then this is the interest earnings in the month. And this is, fiscal year to date over here.
Yeah, part of what happens there too is we pull money out of there, so it gets a little bit.
It does, there's lots of ins and outs, like in this particular month in May, there was rebalancing, so there were sales and there were purchases.
Well, I'm just saying that we have no way of comparing this against some other fund. And occasionally we do get a call from people who would like to come in and give us a presentation on what they're doing. And how do we know, how would we compare this new offer compared to what we have now? And so that's, maybe I'm asking the wrong question.
I think you're probably interested in a number of different charts and metrics.
So I'm interested only,
Just in the return?
I'm only interested in how much we got in the account and what do we get back in income? What's that rate of return?
Okay.
That's why on that, when he says that he can handle that at $30 million, but if you look at the return that they're showing right now, yeah, I understand. In a long term, you would not lose as much you would in your short-term investments now, but look what your short-term investments are paying. So you're starting off at such a better rate that it would take a long time to gain by putting the $30 million with them. My own, for right now, the way the interest rates are, and I don't expect interest rates to get cut drastically or like they went up. I don't think Powell's that kind of a guy. And I don't think our economy in the United States is in a situation where it would warrant doing something like that. He went up fast, but he's going to come down slow. And that's my prediction. Of course, I'm no fortune teller, so time will tell. But I'm saying myself right now, $30 million, you got $30 million to invest. I'd get it in one of the short-term priority yielding. Just simply because, yeah, you can put a 30 million with them in a long-term thing, but you look at the return they're offering you. It's nowhere near this.
Right.
So
And that's what he had mentioned right now, that the LGIPs are gonna be higher at this point in time until they do a rate cut.
I don't anticipate big rate cuts. I just don't see it. But I could be wrong, of course. And even so, it looks to me like you just break even, worst case scenario. I don't think you're gonna have a huge loss at all. But that's me talking, because
So would you rather than keep that, we had mentioned earlier about moving 30 million out of LAIF, would you rather move it just to the other,
I'm more
To
going with
class,
short term.
to the short term, rather than any to Bank of New York?
I'm one voice here, so, you know, I wouldn't want to have you do something on my account, but I'm just saying from what I see of it, sure, they would like to take your $30 million. But they're here to tell you on what they have, what they're doing. So that's why you need to know what's your rate of return, how much you're actually getting back on their investments. That's a fair question as far as I'm concerned.
I suggest that we prepare a draft, work with one member of the elected officials. And once we have a document that we can share with recent performance, that's acceptable, and maybe we work with the chair here to figure out which of the three electeds, but we work on putting together a document that can be shared that's consistent with the vision here.
Well, actually, since I came on as treasurer, I have not gone to any of the state meetings that they have or treasurers. I've just been kind of sitting back and just watching our own local stuff and everything. It takes time and it takes money to go to those meetings. But your former treasurer was actually president of the state association. She was very involved. But that's, that would be one way to try to find out what other cities are doing as far as rate of return. It doesn't matter how much they have invested so much as what's their rate of return, what they have invested. That's what I'm trying to say here is how much do we have invested and what's our rate of return? I think it's a fair question. And it gives you, I keep going back to it, it gives you a point of comparison. If someone else comes that you wanted to listen to about what they could maybe do for the city instead, you would have a point of comparison. And right now, it might be there that I'm not aware of. But I'm not aware of it. I don't get it from his presentation, is all I'm saying. When I go through a 66-page report and I don't see something like this right up front, then I got to go through each line, which I've never done a complete report, but I have taken a lot of different lines and tried to go through it and look and see. Their rate of return is nowhere near. Now, that's not a fair thing to say. Their rate of return today is nowhere near what your rate of return is here. Some of this, I realize it's short term. I know that. I'm just saying that I think what you're doing is great, and I think you'd be better off to keep your 30 million in something like one of these and go with that. So, okay. Then I think once a year or once every 2 years, we should be reviewing and seeing what somebody else is saying they could do for us.
I mean, we did go out to bid.
Yeah, it has to
What
go
was it,
up
like
for-
2 or 3 years ago? And I think it was like a 3-year contract with 2 1-year extensions possible. So it should be coming up. Well, it depends, I guess, if we do the extensions. Could be
Yeah, because
another
we can
year or
always
two.
go out for bid,
Yeah.
and that's when they can come in and show us what they have and what they can do.
Well, that's what I thought.
Yeah,
What did you
that-
ladies think of transferring into the LGIPs or Bank of New York for investments? Or,
Well, I think it's good to have like the different, the different timeframes of maturity. So, I don't know, it's unpredictable.
it is.
It's a tough decision. So, I would just
Yeah.
diversify as much as we can, do short, longer, whatever, just kind of balance it.
You need to be diversified, that's for sure.
Because we don't know what's gonna happen, as they.
Well, we don't, but my own opinion is, if you watch how Powell is worried about inflation. And that's why he went so drastically so fast. And when he finally thought he got to the top, he held it there. Now look, they've been talking about rate cuts since last year, and I mean, at least 6 months ago. And it hasn't happened yet. Now, I think it's coming up very quickly, I guess. But from what's happened, what Powell's done over the last year's time, he's not going to turn that loose in a hurry. He's going to be real cautious about
Mhm.
rate cuts. That's my prediction anyway.
I mean,
Okay,
So do we want to do the 30 million into
Well,
Bank of New York or?
That's up to everybody here, just my recommendation, this is my feeling, and I'm no fortune teller, I don't know what Paul's actually gonna do.
Mark
I
probably
think-
has more experience than Carol and I do in that.
And that's what I was thinking. I
Yeah.
probably lean more towards PTA's recommendation.
I mean, I have municipal bonds that are kind of like, unrealized gain and loss, and
Yeah.
I don't know it on this level probably as much as Mark and his experience, so.
Well, I think, we may want to have a working group in the absence of the ability to form an ad hoc, which is not on the agenda. Have a working group to dive down a bit deeper with PTA and the concerns that have been addressed. I think there's a couple of deliverables. One is a short condensed summary of performance. I like trend data, so I'd like to see at least 3 years of data in that, in both a graphical representation along with numbers, and maybe a couple of other charts. That's for me.
Oh, they gave up.
Well, for sure, and you're right on that, and I agree with you there.
It was
We should be trending up,
Who are they?
or right now, we should be level.
It was my 5 o'clock meeting. It was our 5 o'clock meeting.
Looks like Mike Morrell, is it Mike Morrell?
No,
No.
Oh,
No.
looked like Mike Morrell, the glance I got. What would he be doing here?
And the second deliverable would be to, spend more time on the $30 million and make an informed decision to the best of our ability based on concerns that have been raised, feedback from fellow trust advisors. And I think consideration of near and longer term challenges. I think one of the challenges with, I agree that diversifying the portfolio is the best of all worlds. But I know that we can't put it all in 1 year because we might end up in a really low environment and miss the opportunity for larger returns later if we have some of that in longer term investments. So there's a bit of and I also don't have the investment policy in front of me, but I'm sure doesn't tell us exactly what to do. But I'm also wondering if there's any guidance that we would derive from a review of the investment policy that could guide some of this. Or a peek at some, or consultation with others, because that's always another option too, is to touch base with some other third-party professional, receive some independent thinking. Talk to other treasurers or professionals in other agencies and run our consideration, our thoughts by them, and get some independent feedback from members of CMTA and treasurers that are deeply involved in that organization.
How about other city managers? You guys ever talk about stuff like that?
I think I would probably defer to the finance directors who are taking on treasury roles these days.
Yeah,
And,
well, that's what you need. You've got to have a point of comparison. You really do. And the more, the better. And so I've thought about, well, what if I attended some of those state meetings, would I run into some of that information? I don't know where to find it right now. That's why I call Michael Vanderlyn and find out from him. See what kind of return rate he's getting.
Well, what's funny is one of their investment firms is PTA.
Oh,
That handles their
no
investment.
kidding.
Yes.
Well, I could be wrong. Don't get me wrong. Well, I said that.
But they have, San Jacinto, when I was the treasurer there, they split their money between 2 investment firms to see
Oh,
if
yeah.
you could give them a better
That's
return.
kind of interesting.
And I think they still have it split between 2 firms.
That's interesting, yeah.
Mhm. Yeah, so that's another approach maybe for later on.
The other option is in the short term, we can always still move some of that money out of LAIF into one of the other, either California Class or Cal Trust.
That's true, we could do that right away.
And that would earn us something more.
Yeah. I'm surprised life returning what it is right now. It's not a bad return.
Mhm.
it's actually quite surprising. Yeah.
Yeah, but compared to past performance, wow, that came up pretty good.
One of the things I've noticed too, and maybe we just put it on a agenda item for December, is the investment of the LaSalle endowment is kind of outside of PTA's jurisdiction because it's its own, I don't know, because of the nature of it. Right now, we have it in Leaf, we've had it in Leaf. But I don't know if anybody wants to consider, if interest rates are gonna start being cut, if anybody wants to consider.
And what is
moving
that for?
So it's there's a endowment that the library has, it's $1 million. I don't know
Oh,
if you've
okay,
heard of The
okay.
LaSalle endowment. And it's that $1 million is invested because we don't touch that principal, we just use the interest. from it.
Right, yeah,
And right now that is in late.
okay, that's, yeah.
Judy moved it out back when interest rates went down to nothing. She moved it into Leif, but we used to have it with
It was in Bank of New York.
in Bank of New
And it
York
was
in like
invested.
something,
CDs,
the CD
yeah.
or something. So I don't know now who can advise on that.
Yeah.
If they, that should be moved back into Leif, or moved out of Leif back to the Bank of New York or.
Because right now,
the interest
it's
rates.
commingled in with all of the other investments in the Leif investment. So we have to do like a calculation to make sure we're booking that interest for that.
Yeah, a line item.
Separately.
Instead of being clearly identified as a line item in the Bank of New York statement, so we know exactly what interest is going to that investment.
Yeah. Okay.
But yeah, we can bring that as a item.
We can also bring that same type of, if there's a monthly report in the future, we can bring that to the city council literally monthly. I think we found that in a prior agency that a quarterly report was a little easier to do. And so a quarterly type of report to the city council for transparency purposes also keeps us organized, right? If that's happening and that data set's being created. I'm looking at the county of San Mateo. They actually have quite a lot of detail in terms of how to limit and form their investments. It's actually remarkable how much detail is here. And there's a reference also to how the data is shared. I believe they have periodic report and monthly report for the county pool participants and members of the county treasury oversight committee stating for each investment, the type of investment, the name of the issuer, the maturity date, par value, current market value, and the securities rating. Monthly cash flow report. And then they post it on their website. So I know there's additional. But I think distilling down is one of the points here is we will benefit from an easy readable document for all of us, but also for our community. So that people can see in a succinct way what
The community comes into play because of Measure U, back when it was Measure U. That you hear that complaint every so often about the Measure U funds are being missing. And so that's just part of the.
And the good news is
Trying to tamp down the rumors and all that.
And the good news is every transaction today we've been posting to the website. So every single transaction is there for transparency today.
So transparency. We did agree at one time too, to have a quarterly meetings for investment. Or investment committee.
Yes, and that's ideal, what the goal, it's just staffing kind of went a little sideways.
Yeah. Jump on, see this down.
PTA does.
Because it's, let me finish that thought, but if there's critics out there, and there are, then when we don't have regular meetings, and not just this committee, but any committee that's supposed to have regular meetings and it doesn't happen, it looks like happening. It looks like you don't care. It could be interpreted as that. Not knowing that we just don't have the staff. But yeah, keeping the critics down and informed. But regular meetings tends to make it look like you're really on top of things. And well, I'm not jumping on anybody because we haven't had, believe me. I sympathize with all the work you have to do. But in this case where they are being paid for a service And I feel they're not giving us a good, that summary. Then what's up, fellas? How come? Is it because, no, this comes into my mind. Is it because you're not really doing that great and you kind of don't want to let us know about that? So that's where we're going line by line by line. And as I say, I'm being redundant again. I've never gone through one of those full things all the way down to the bottom, but I have pulled up quite a few lines. Look and see what their average rate of return is. It's really not that much when it comes right down to it. Especially compared to numbers that you're getting. Not safe investment, I'm not arguing that. That is very diversified, I'm not arguing that. But it's not that great a return. But proving wrong.
I was just gonna add that PTA does have available on their website, quarterly reports.
Yeah.
Of the monthly, they have monthly and then they have quarterly. Now, they are very long, like their monthly ones are though. So, but we can ask PTA or we can create a simplified summary sheet
What a summary.
to summarize what's in that quarterly report.
All these reports should have a summary right on top.
Mhm.
I mean, that's. Okay, well, I'm keeping this.
There's nothing else. I will adjourn this meeting at 6:11 PM.
You had 5 minutes to summarize the other meeting. I can give you a bit of background on what I think
See you
the focus.
Thank you.
What other, oh, did they just have it without us? Okay. Yeah, that's our 5 o'clock walking out. Can I use the restroom? Like I'm.
Dying. Let's see.
I wanted to see pictures, Carol,
Oh,
of the little guy.
Oh, yeah, I'll show
Oh,
you.
okay.
Okay, I'll allow it.
I just sent you a report from Alex Verde's estates. It's pretty detailed.
Okay.
But I think it kind of touches on a lot of, I looked at a lot of different agencies and then it dawned on me that I should go back and look at them because they are hyper focused on yields.
Okay.
And I mean, they have some of the smartest finance professionals in the country living in their city. And
Oh, I feel
they're
like.
making some money over there. So
Maybe,
the,
I'm sorry.
the report is pretty detailed.
Mhm.
And I don't know if we can build a spreadsheet like what I sent you. But
Yeah, and all the time we don't have.
well, I
but-
make them do it for you.
PTA, yeah, and that's what I was trying to show him. They create that customized one-page summary that maybe we can ask them. This is page 8 of their big report they give us, where it has like the type of security and the book yield over here. This is on the monthly basis. I wonder if we move something like this up to the front of the report.
Yeah, I would agree, but I like data over time. I want to see. I think it's gonna be helpful to him too, to see
Yeah.
data over time. That's why I don't want to lose too much.
Yeah, I was gonna say, I don't know what that supposed to mean, but,
I was just up there for like 2 back-to-back weekends.
Oh,
And so I took a lot of pictures because I was trying to get like
Investments.
stuff for my campaign. So there was actually one of those.
Here, but.
We did.
how does he know?
He will, he's 8.5 months old.
This is important.
So, okay, so it's the first weekend I was at.
Weighted average.
So they were all in a wedding.
Oh,
So
his hair looks so reddish.
it's like crazy.
yeah, I'm gonna say, I think a lot of that information is here. It's just you're talking about just putting it in a different place.
His little friends.
Yeah, so,
Or, yeah.
No, that's
little Zaid.
Zaid.
Yeah, so this
Okay.
is like, this is going on my campaign flyer. My daughter took this. It's me reading the Hungry Caterpillars to him.
Less than a year, 1 to 2 years,
So-
2 to 3.
He's a chunker. He just got his top teeth,
on-
he's got
okay.
4 teeth now.
Investment. in 2022.
I am so in love.
Yeah,
It's like
did you
we
get
were
to be there when
banking
he was
on long
born?
term.
But they didn't have anybody in the room, but I was there, I was up
okay.
there.
Okay.
So they decided that
But the risk was to be
They-
over-invested.
they didn't want,
So
so it's like me and Taylor and him.
I think that's
My
where.
eyes are closed. We were trying, he was not cooperating.
Yeah.
Takes away the balance.
So,
He was so,
yeah, he's,
Guidance on-
and so
What is our investment? What is our investment?
the kid, today's their wedding anniversary, so. But
Oh.
no, I
Website somewhere?
I just-
I-
I'm so in love with this kid. They're gonna start trying for another one.
Oh.
At the end of the year.
that's
So,
exciting.
Tiffany, can you stop the meeting?
Oh, no, I think we are.
Or are we on, we're stopped?
That's recording.
Let's see.